Today, we will be covering how in the past couple of years there's been an explosion in the number of approaches to revenue management. Today, we'll discuss how to simplify your revenue management strategy. You'll walk away with 5 important lessons, and you'll learn key metrics to watch for to increase your revenue. Our presenter today is Kevin O'Rourke, Executive VP of Global Sales at SiteMinder. He'll be joining us from Dallas. Later on, we'll be having a discussion. We'll be joined by Neil Kaur, Senior Advisor for Ideas, the revenue management company. He's speaking to us from London. I'm Sean O'Neill, editor of Tnooz in the Philadelphia area, and I'm joined by Gene Quinn, CEO of Tnooz from Connecticut. You'll be hearing from our presenter, Kevin, very shortly. Just a bit of housekeeping, 2 things. First, Tnooz is recording today's webinar, and we will make a replay available to you. We will email you a video replay and the slides within about a day's time, and you will be able to share this information with your colleagues. Second, we will have a question and answer session at the end. If you have a question, please use the box on your GoToWebinar panel and type in your question. I'll read the questions and then ask the presenters at the end. I now turn the presentation over to Kevin O'Rourke.
Thank you, Sean. And I'd like to begin by saying how thrilled I am to be joining Tnooz for this webinar, and also preview that we do have a great panel discussion coming up, so hope everyone hangs in after the presentation to be a part of that. But first, we're going to move through a discussion on simplifying revenue management, specifically why revenue management can be seen as too complex, the lessons learned that could make this simpler, and the specific metrics you can use to make better business decisions at your hotel. Next slide, please. We know that revenue management can get very complex, and it can get there very quickly. And while I will not go back to the origins of revenue management to where a lot of these presentations begin with the mathematical models that were invented in the airline industry, but one thing that we should level set is that revenue management continues to evolve. And one of the biggest areas of change has been that demand patterns are much more unpredictable. It's becoming increasingly more dependent on user-generated data and especially customer reviews. And another is the rise of not only mobile, but mobile apps. We have an entire generation that's entering not only the workforce, but entering the tourist ecosystem that simply does not tolerate being tethered to a computer. So they make a lot of their decisions research from their mobile devices. And guests more than ever have more access to information from more sources before they'll even book a room. And as a result, hotels need to keep pace with the tools that are available in order to react and begin to hopefully not just react, but to hopefully become proactive. Next slide, please. So here at SiteMinder, we were lucky enough to be a part of a major Focusrite study looking at the independent hotel sector. And we asked hotels primarily in the US and Europe about the technology they use every day in their properties. And there were really 3 common themes that came out of our study. The first of which being that rates and availability are still very much a manual process. The second is that there is still little structure to pricing rooms. And I'll submit without that structure, it makes any channel optimization very difficult. And the third is that the concept of dynamically managing rates and availability are still not widely adopted. Next slide, please. Our study at Focusrite went further. We asked hoteliers how much time they dedicate to revenue management, and the consensus across this question as well, across the board, was very little. The majority of hotels are simply experimenting with price changes, and they're doing this without any type of software automation. But intuitively, hotels know that when occupancy is low, they know how to drop prices, but they're not taking advantage in times when occupancy is high by increasing prices. And if they are, it's happening too late when rooms are sold out or we're outside the booking window of a certain segment. And that makes us wonder, perhaps it's because it's too hard or too complex. nor is anyone at the property looking to pick up more tasks in their already very busy day, and we're always aware of that. Next slide, please. So despite many simple and affordable solutions that do exist, hoteliers continue to use these complex manual processes. And this has given rise to the next problem, which is systems being an island of information that can't be shared across multiple systems. Also across our study and across both Europe and the US is that only about a quarter of hoteliers are automating these processes. This is a lot of great data in our study to validate that we're complicating a process with a fairly simple outcome. And that outcome is perhaps one of the best definitions I've heard of revenue management, which is to sell the right room through the right channel to the right customer at the right price and the right time. Next slide, please. So getting started, we recommend 5 steps to simpler revenue management, with step 1 being data collection. And you can make this as simple or as complex as you allow this step to be, but you'll need to collect some historical data on your market. Things that we like to include are your historical business mix, your booking window of certain segments, any stay patterns that you can identify, including the days of the week that are the busiest. And this will allow you to make more informed decisions. Next, you'll need to build an unconstrained forecast, meaning not constrained to the number of rooms in your property. So if you're a 60-room property, or excuse me, if your forecast is 60 rooms, but your property only has 50 rooms, your unconstrained forecast is 60. This allows you to manage the inventory based on the highest payest segment, allows you to make those choices, and determine if you need to make alternative arrangements for another segment. The next step is probably the biggest, and it's probably the biggest change for many, and that is to commit to a dynamic pricing model in order to maximize yield. And the reason why I've chosen the word commit is that you can't run a one-day experiment on a rate increase and drop that strategy if your day one result isn't great. This is all about improving your averages, and the best way to do that is our last step, which is reporting on your performance. And we'll talk more about that throughout the presentation. Next slide, please. Revenue management is a structured process. We recognize that. So permit me just a few minutes to level set some basic terms. And the first is BAR, or best available rate. This is your walk-in rate or phone rate. Many hotels will refer to this as their rack rate, but this is your ideal rate that you want to receive. ADR, or average daily rate, is your revenue divided by rooms sold, but it also includes discounts and commissions that you may pay out to the various channels. So ADR is almost always lower than BAR. Revenue is fairly straightforward, but the call out here is to look at it as a snapshot in time, like the previous day's revenue, last week's revenue, or last month's revenue. It simply isn't good enough to look at it over the course of a year. Occupancy I don't need to touch on, but RevPAR, or revenue per available room, is perhaps the hallmark for revenue management, which is the revenue divided by all rooms, including the vacant rooms. And this is one of the best measurements of revenue management performance, because revenue does vary by hotel size. A 15-room property has less revenue than a 100-room property, but RevPAR allows those two hotels to put themselves or measure themselves with an equal measuring stick. And when you put this into a simple table, they're essentially levers that can improve your revenue. Next slide, please. The last term to reflect on as part of your revenue management strategy is your comp set. But this time, don't just dismiss the fact that you already know my comp set, and I think that's a mistake that we can often make, or we haven't updated our comp set. But truly evaluate your list of competitors that are most similar to your property at a similar bar rate and offers similar products. It's not always the hotel next door or down the street. So you want to choose a comp set that reflects your market segments as well as the demographic of guests you serve. Whether it's a leisure destination, a corporate traveler destination, or that property has the amenities to serve groups. Competitive markets can also come into play here. So if you're a hotel that's located off an Autobahn exit or an interstate, your comp set might include the hotel that's a tank of gasoline or petrol away. Hotels in the tourist zone of Barcelona might compete with the hotels in the tourist zone of Cancun, Mexico, if both destinations are serviced by the same originating airport. You'll need to do your homework, but the technology has come so far that collecting data has become as simple as clicking your property off a digital map location or a simple click or search to add a competitor. And by the way, you can get started with this today for free with one user looking at 2 competitors just by going to our website. And there's many options out there, but the trick here is get started and begin your data collection. Next slide, please. So as we transition through the next few slides, I'd like to share some real quotes about revenue management. And as I go through them, ask yourself if any of these statements ring true. For each of the 5, I'd like to recommend something that you can take back to your property today to get started with. Starting with our first quote, which is, I don't have rate visibility and can't check for accuracy. And this is a fairly common issue regardless of how many room types your property offers. The number of rate plans can multiply very quickly depending on your market mix of guests. Bar rates or rack rates, such as OTAs, advanced purchase, and promos, have added an additional complexity around the rate parity rules that apply to most of the world, let's say today. You also need visibility for your non-bar or private rates, such as corporate pricing, consortia, locally negotiated rates, maybe national rates, wholesalers, redemption. And our simple advice here is to automate your distribution, and that will allow you the visibility across multiple booking channels. But perhaps the most important piece is for it to be a two-way connection back to the PMS or property management system where the rate plans live. And just as important is to take advantage of the concept of pooled inventory, and that helps you manage the overbookings so you don't inadvertently walk someone if a reservation is made on one particular OTA, but instead all channels are updated on that inventory change. But without automation, it's going to be very difficult to keep track of all your rates. Next slide, please. The second is, I already have a competitive edge. And referring back to our simple table 2 slides back, the revenue manager with the lowest bar rate is going to think that is his competitive advantage. The revenue manager, let's say with the highest occupancy or sellout efficiency, will think that selling out early is his competitive advantage. And if you're measuring your competitive edge this way, or even by average daily rate, I would encourage you to compare your RevPAR to your competitors to assess if you truly have a competitive edge. And I have a quick example on the next slide. So in this example on the left, we have a revenue manager that perceives his bar rate as his competitive edge. He has the best available rate in the surrounding area and therefore sells out like he has done on this particular day, 100% occupancy. But the revenue manager on the right, who has strategically increased his bar rate for the same 100-room property on the same day, has increased the hotel revenue by $3,500 USD, even though his occupancy was at the lower 88%. So clearly the revenue manager on the right was able to manage the rate as inventory dwindled, and the results are meaningful. This is just one day, and one day added to the revenue stream of $3,500 USD. The simplest way to do this is to keep an eye on your comp sets availability. So what we're saying here is you don't even have to pay attention to the rates at this point. If your comp set is out of inventory, it's simply time to increase your bar rate or rack rate. It might cost you a few percentage points in occupancy, but you want to be the hotel that's at 88% occupancy with less wear and tear on a particular day, instead of the hotel that's at 100% if it means your revenue has increased. And by the way, what you've also done is inadvertently save space if you have any walk-ins that happen on the last day. Next slide, please. Our next quote is, I don't have access to the right amount of reporting. And reporting is everything, and understanding your performance should underpin your decision-making. While many of the large brands or properties within large brands have access to systems that can enable a property to optimize revenue, smaller brands and independents are still using manual spreadsheets that are just not as efficient, which leads to longer lead times to disseminate those price changes. Furthermore, we like reports from STR or Smith Travel Research, and they can be very helpful, particularly after you've built a comp set. We also like Sojourn's quarterly update, which speaks to changes in traveler and guest behavior. But if you're an independent hotelier, that subscription could cost you as much as $1,400 annually if you want that reporting in any type of regular basis. Next slide, please. So once you have your comp set selected and you're beginning to collect data, we recommend 3 simple reports that you can build with local fact checking. And the first is your market penetration index, which is your hotel's occupancy versus your comp set's occupancy. A result over 1, which is achieved by simply dividing your occupancy, let's say it's at 70%, by your comp set's occupancy, which might be 68%, that results in a result over 1. That means you're getting your fair share. Less than 1 means you're losing customers, or you were possibly too aggressive raising your bar rate over that period of time. The same is for the next report that we recommend, which is your average rate index, which is your ADR versus your comp set's average daily rate. Again, over 1 is good, but this is an indicator that revenue management strategies are starting to take effect on an average basis. And then our third that we recommend, which is your revenue generator index, which is your RevPAR divided by your comp set's revenue per available room. And we think this is an indicator that you're starting to optimize a full revenue management strategy. This can be a report for the last business day, it could be the last 2 weeks, or last month, or it can simply be an audit of your revenue strategies if this isn't something that you're doing already. And as you analyze the results, ask yourself, what was happening a year ago in my market, both positive and negative? Was there a local event that took place that added to good results? And similarly, was there bad weather or an air segment trend that led to poor results? Next slide, please. The next quote is, I have so many targets to manage and I find forecasting among the most difficult. So regardless of how far out you try to determine your forecast, you want to have a simple pickup chart that reports your day-by-day reservations by segment, and most hoteliers are already doing that. Some hotels have requirements to forecast a year or more in advance, but the booking window has changed so dramatically in the digital age that many hotels that I speak to are focused on first confirming their groups, the larger groups that are already reserved at the hotel, wash them or reconfirm that they're all set for their stay, and then more tightly manage the 30 to 60-day forecast window because certain segments are booking that close to arrival. But once automating your rates and availability, there are several tools at your disposal to manage your forecast. For starters, you can block certain segments from speculating your property for an upcoming event or a peak demand period, and doing this too far in advance. And if you've automated your distribution, you can deploy availability tactics very simply with the click of a button to stop sell, ask for a min stay, a max stay, as well as close to arrival or close to departure. And you can do this for all channels, or you can do this for a single channel. This allows you to peak a peak period and really maximize revenue. Next slide, please. The last quote is, I don't have time to keep learning to use new systems and technology. And I'll be the first to submit that our industry has been guilty for years now with a feeling of, if it isn't broken, don't fix it. And part of that is because legacy systems were so expensive, and it took an entire information technology team to install it. So if you finally got it working, there was no way you were going to rip it out, despite the fact that it was going to provide savings to move to a different technology. But today, solutions are so ready to use with a simple logon and password. In many cases, you're up either instantaneously or over the course of a few days. And you don't need a degree in software administration to use it. And in many cases, your payback is one additional reservation per month for what you're going to pay in a subscription fee, or one day of improved revenue, like our earlier example. So I believe we're going to pause here, and I'd like to hand it back to Sean for our first poll question.
Yes, Kevin, we're asking 2 poll questions of the audience today. Please answer the questions you see in the poll section of your screen. Our first question is, which of these 5 statements about revenue management rings true with you? I don't have rate visibility and can't check for accuracy. I already have a competitive edge. I don't have access to the right amount of reporting for my property. I have so many targets to manage, and I find forecasting among the most difficult tasks. I don't have time to keep learning to use new systems and technology. We thank everyone for participating in this poll. It gives us a better sense of how to handle the discussion section that is coming up. We also invite you to ask questions using the questions box. If there's something that's been discussed so far and you have a question on, feel free to use the questions box on the right of your panel. So it appears that about a third of you, 37%, say, I have so many targets, I find forecasting the most difficult task, 38%. About 18% say, I don't have time to learn the new systems. About 19% say, I don't have access to enough of reporting for their property. 15% say they already have a competitive edge, they're not worried. And 9% say that I don't have rate visibility and can't check. Kevin, do these results surprise you, or are they in line with your expectations?
Yeah, it's a great question, Sean. It really is in line with our expectation. In fact, when we started this study, we had originally had 10 different answers, and we really boiled it down to what we thought were the 5 highest running. And to me, this really validates that there's a cross-section of challenges. But again, hopefully one of the takeaways here is that there's something that you can do for each one of these things that we're having validated from our audience.
Fantastic. And we have a second poll question coming up, which is, do you use tech to automate your hotel's revenue management strategy? Yes? No? We're thinking about it. This is our other question for today. Do you use tech to automate your hotel's revenue management strategy? Thank everyone for participating. We see 46% are saying yes, 23% no, and about a third of you are thinking about it. That does seem to dovetail with the research that you were providing earlier, Kevin. I turn the presentation back over to you.
Great, thanks again, Sean. So I'd like to transition into our next subsection, which unveils 5 important lessons learned from other revenue managers that are struggling with some of the same issues. We interviewed several of them to get their take on how hoteliers can simplify revenue management. So here are 5 more recommendations that you can get started with, hopefully today. Next slide, please. And the first is to treat revenue management as a marathon, not a sprint. And I realize this could seem pretty obvious out of the gate, but the first lesson that we're reminded of is that selling room inventory is a perishable asset. It's no different than trying to sell an airline seat after the plane has taken off. There is nothing you can do to sell yesterday's room, but you can focus on tomorrow's or next week's. But you'll need a total distribution strategy to get that done. If you are not getting group RFPs, today, right now, you can go to cvent.com and add your property to the RFP platform. And this will give you exposure to an entire ecosystem of professional meeting planners that perform that job every single day. And if you're thinking to yourself that doesn't apply to you because your meeting space consists of a single conference room behind front desk, keep in mind that 90% of group business is small meetings under 20 people, which tends to be too big for an office location, but an ideal location for small meeting space in a local hotel. And these are happening every single day. So if you're not in that inventory, get yourself on that inventory. It's simple and it's free. Secondly, if you're not winning enough corporate transient business, are you considering GDS connectivity? You have an opportunity to win more if you get connected to the TMCs and the consortium markets if you have a GDS strategy. And you can add this to your channel manager today. And are you on enough OTAs? Booking.com and Expedia are great during peak demand. But our research shows that being on a third, a fourth, or even a fifth OTA will help during your non-peak periods. And lastly on this point, domestic tourism is booming all over the world. Coupled with global tourism, you have a solid opportunity to attract new guests and boost revenue. This is what the OTAs are great at with their deep pockets of marketing spend. Are you connected to the OTAs that are bringing these international travelers to your market? Next slide, please. Now that you're on the right channels, try for a balanced business mix. Communicate with and reconfirm your groups that you already have on the books. This will discourage them from continuing to shop. You should also establish local business relationships as being the hotel of choice for local companies when workers arrive from out of town. And you should also understand your historical percentage of no-shows and consider overbooking by that percent if you can see the historical trend there. Understanding your booking lead times is also critical. And lastly, make sure you're saving enough space for higher paying segments, as this equates directly to higher yield. And I know that this can really test a revenue manager or owner or a GM's nerves to do this, but the results are proven that it leads to higher yield. Next slide, please. Third from our revenue managers is to access your demand levels to understand how that changes from season to season. Look at your demand by day and look at it by segment. Use it to identify opportunities of demand. If you have a large decrease after a peak period, deploy your availability or length of stay tactics. Manage your bar rates day by day, which is something that we see a lot of our European customers embrace. Maybe not as much in the Americas, but this is an advantage that you have over the largest chains that try to manage full pattern length of stays, and again, particularly in the US with the larger chains. But the optimization tools that we've been speaking about here used to be exclusive to these larger brands. And now that they're so affordable, it allows the independent or the smaller properties to compete on an even playing field. Next slide, please. Another recommendation is to watch your local competition. This is really simplifying your opportunity to increase or lower prices, even if you're ignoring the other historical data. Pay attention to rates, but also the availability, and be able to react quickly. Independent hotels have felt that they don't have the option of using technology, but now they really do. Many vendors, including SiteMinder, have a rate intelligence tool to give you access to what's happening at the competitor. Booking.com recently released a tool. Expedia just released a tool to catch up, you could say. Choose a tool that pulls from multiple data sources instead of just a single data source. It'll give you a better cross-section of what's happening in your market. Additionally, the tools need to provide a flexible view. What is happening today is still an opportunity, but it should also be able to look out 30 to 60 days when the volatility of the market is at its highest. But it also needs to provide a more distant view to spot large demand spikes like an upcoming festival or event or one-time thing that isn't going to happen every year. The alternative is a little bit scary to think about. It's to browse the web and assess combinations of length of stay, and that's almost an impossible task. Next slide, please. Another lesson learned is to analyze the spending power of your guests. And we talked a little bit about this, but a group that may have negotiated several rooms at a higher discount can very quickly and very easily make up that difference by needing meeting space, which you may or may not choose to charge for, but it also provides all of the upsell items that go along with the group. And that includes AV cost, because no group ever arrives with the AV equipment that they need, or the screen, or the right cable. And it's also a nice increase to your F&B revenue. You may also have to discount to win some corporate business, but the transient business traveler is far more likely to stay on the property for meals. He or she is far more likely to need amenities such as laundry or dry cleaning, and is far more likely to raid the minibar when they get that late check-in after a long day on the road. Allow your returning leisure guests the ability to book next year's stay as they check out, particularly if you're in a holiday destination. So look at your markets, see how the length of stay and spend varies, then share those findings with the key stakeholders and use it to prioritize not only your distribution channels, but your marketing initiatives. Little things make a big difference here. Next slide, please. Lastly, let's take a look at how to action some of the data of some of these discussion points that I laid out. Next slide. I'll leave you with a few final recommendations how to put your revenue management strategies into action. And the first is that we recommend a channel manager that allows the greatest connectivity options, whether that's to the OTAs and all the different flavors of OTAs that are out there, the GDS to attract more business travelers, meta-search, wholesalers, as well as providing connectivity back to your PMS to keep everything in sync and stay updated on availability. We also recommend that it should accept a rate from your RMS. When your comp set has run out of inventory or other market dynamics have changed, you can quickly apply what you've learned, but do it in an automated way. Take advantage of your revenue analysis and disseminate your rate changes immediately and in real time. Put your revenue management strategies into action. Deploy a channel manager that allows the greatest connectivity options, again, to all the various channels. Take advantage of this, and again, here's where little changes will make a big difference to your revenue management strategy. Next slide, please. So we still haven't spoken about what could be your best channel in terms of attracting new guests, and that's with a positive first impression, and that's your direct booking engine, which can not only be one of your best channels, but it can deliver commission-free bookings that leads to more profits. So look for an online booking engine that will integrate directly with your website content management system or editor. This allows you to keep it up to date and have fresh content, which is what guests are looking for. Display information in multi-language, multi-currency. I'm sure I don't have to convince that to all of our European hotels that have joined our call this morning or this afternoon. And also, it should support bookings from any device, whether that's mobile, tablet, a desktop. Again, the part of, we have an entire generation that's entering the tourism ecosystem that's booking these things from a bus or a car. They're doing less and less pre-planning. But your direct online conversion rate, the promotion codes, and generating the most revenue for your hotel can be seen and analyzed here. Next slide. Okay, one final point, and I'm going to try and wrap up. And that is your online booking engine goes hand in hand with your hotel's website. So look for a website management tool that can keep your site up to date and relevant. Be found on any type of device, and perhaps most importantly, personalize your upselling to your guests. This is a proven tactic that has worked. And In summary, we talked about reporting as the last step in your revenue management strategy. It started with the need for some data collection and building a forecast. But we also spoke about managing your inventory, rates, and making a commitment to dynamic pricing. You'll need to understand the broader picture of your market, and that's why the reporting is so important. Simply put, doing these things will allow you to sell the right room through the right channel to the right customer at the right price and the right time. So I hope you found this part of the webinar helpful, and I wish all of you well in your pursuits of simplifying your revenue management strategy. Sean, I'd like to hand it back to you.
Thanks, Kevin. We'll go straight into the question and answer session now. We want to bring in now Neil Kaur, Senior Advisor for Ideas, the revenue management company. He's speaking to us from London. One question from our audience is someone didn't understand the concept of unrestrained forecast. Neil, would you mind elaborating a little, please, on unconstrained forecast?
Certainly, Sean. Thanks, Kevin, for the presentation. Quite a key evolution in forecasting strategy over the last few years has been the introduction of an unconstrained demand forecasting, which simply put just means demand regardless of a hotel's capacity. So there's some debate as to what constitutes demand for your property, but generally speaking, we're talking about the general demand, which could include cancellations and non-arrivals, on top of the materialized demand for the property. So the demand, regardless of your hotel's capacity, is a great way to understand the pricing potential that you might be able to achieve.
So Neil, another question from the audience is, I often hear experts distinguishing between yieldable segments and priceable segments. What's the difference and what's your position?
I mean, such is the development made in revenue management and revenue optimization, you do tend to veer into a lot of semantics and different terminologies, but generally speaking, being able to identify the yieldable and non-yieldable, instead of comparing it to sort of priceable, is sometimes a more helpful definition. In other words, the business that is not fenced, is not restricted, is not subject to contractual terms versus the true sort of bar or transient business, which you are able to yield manage or revenue optimize based on dynamic pricing. So the distinction there is quite clear, and very often the true opportunity for revenue gain can be around the percentage of yieldable or transient business that you have at your disposal.
So a key point that Kevin brought up was trying to use RevPAR as a performance measure, because it sort of makes a good comparison whether your property is small or whether your property is large. One audience member is asking that given the increase in customer acquisition costs, is there a risk that a lower RevPAR made in majority by non-commissionable rates is better than a high RevPAR impacted by high commissions paid to third parties?
Yeah, it's a very good question, and what I'm sure many on the webinar have recognized in more recent times is with the greater advances in revenue optimization, the closer alignment with the property and the finance directors and managers and so forth, the adoption of gross operating profit per available room, or GOPAR, has become more and more commonplace. This will expose the true cost of acquisition and look in terms of the profit per available bedroom. Whilst RevPAR is still a very adequate and uniform metric that's commonplace now for rooms yield, gross operating profit per available room is also a very useful key performance indicator to measure the profitability of the inventory that you're selling.
Thanks, Neil. How can we calculate the conversion ratio per country? Where can we get the most accurate data?
Again, that's a very good question. We find that a lot of hotels, back to Kevin's central point about simplifying their yield management strategies, very often we can go hunting for origin or source data, even looking at the granular data through certain countries. this can often be the wrong place to start if, in fact, you have very poor market segmentation data that's going to drive your forecast, or, for example, very basic channel mix reporting to track, as Kevin mentioned, OTA, GDS, direct channel, and web. So where such data does exist through a number of different sources, some OTA channels, some GDS providers, but personally, looking traditionally at simplifying revenue management, it's probably not the best place to start.
So Neil, there's a small independent brand that is asking for some recommendations for simple technology for monitoring its comp set. Do you have any recommendations for tools for monitoring a comp set?
So probably one of the sort of newest additions in terms of data sources over the last couple of years, both for manual operators and hotels that are quite heavily automated, is the new abundance of online reputational or sentiment data, which is now being aligned with rate shopping or competitor data. Fold into that benchmarking data for historical trending and macroeconomic performance, you can see that complexity begins to unfold. So it really depends on the capabilities and the key objectives of the property, and very often, what is their pricing strategy? Are they going to be adopting a penetration pricing strategy, a match pricing strategy, neutral, skim, and so on? There's many forms of pricing. So probably in this instance, we look at what are we truly trying to determine, the price versus value proposition of our hotel, or do we want to really understand market share? So in the ideal world, you would have competitive sets that would be consistent across all of those data sources, but often that's not always available.
Okay, two more questions. Neil, is there a way to find out the overall room availability within the comp set? Is there any tool or method? Rohit is asking, and you may have an answer to that. I'm not sure.
Yeah, so commonly, looking across the piece, there's a number of leading benchmarking vendors that provide information on volume, on the traditional key performance indicators of occupancy, average daily rate, and revenue, then transferring the volume of rooms, the supply and demand chain in any region. So provided your local hotel base are subscribing to such tools, it becomes a lot easier to look at the total capacity and therefore your market penetration index, for example. But often you're at the mercy of subscribing groups, which are normally predominantly the large chains that subscribe to such data. Unfortunately or fortunately, depending on which way you look at it, due to competition law and other constraints legally, the kind of good old days when you could phone around your competitors and share such information are long gone. So the investment in some of that technology, some of that reporting to determine market share opportunities are very important.
All right, thank you, Neil. Dave, if you're still with us, a question about what is the name of the corporate meeting registry again that you had mentioned as a tool?
Cvent, cvent.com. And there's really...
Sorry, I apologize. That's cvent.com?
C as in Charlie, CVENT. And just to expand on that, there's really two players in this market for the group RFP business. The first is Cvent, but for those that have been in the industry, you may remember a company called Starsight. Starsight has gone through a couple name changes, but the assets of Starsight are now within the Lanyon umbrella. So those are the two tools that are out there that really attract all the professional meeting planners. There's been recent news in the market that those two companies have announced plans to merge. But in my experience, Cvent is the easiest to go to because they really invite and they really have a focus on the mid-tier and independent hotels to broaden their inventory. Because again, most professional meeting planners are looking for small meeting space as opposed to convention centers and other venue sources. So it's a great tool and it's free to get it's free to get added.
Thank you. Thank you. Time is a factor, so we have to wrap up today's webinar. You will receive a video replay of today's webinar by email. You'll also get the slides, so you can share those with your colleagues. Well, you want to thank all of our panelists in the presentation today, and thank you for joining us wherever you are in the world. Hope you have a good day, afternoon, evening, or good night.